How did I get this setup? This one and this one, all stacking profits while retail traders were crying stop losses. Simple. I wasn't gambling. I wasn't chasing green candles like a headless chicken. I was using one of the simplest, cleanest strategies you'll ever learn. The 50 EMA combined with the fair value gap. And today, I'm going to break it down for you like no one else does. Now listen, before you skip ahead thinking this is just another moving average strategy, stop. This isn't your usual crossover nonsense. This isn't when the 50 crosses the 200 go long. No, this is a sniper's game. We're using the EMA not as a signal, but as a filter. And when you pair it with the concept of the fair value gap, you suddenly start trading like the smart money. So let's start from the basics. What is a fair value gap? Picture this. Price makes a big, impulsive move. A massive bullish candle rips through the chart, or a bearish one nukes the market. In that moment, between the three candle sequence, the market leaves behind a void, a space where orders weren't balanced. Buyers didn't get to sell, sellers didn't get to buy. That imbalance is called a fair value gap, or FVG. And guess what? The market loves to return to those imbalances because markets crave efficiency. They hate leaving unfinished business. But here's the catch. Not every fair value gap is worth trading. Some are traps. Some are bait for impatient traders. And this is where the 50 EMA steps in. The EMA becomes your lie detector. It's your filter. It tells you which gaps are worth your time and which ones will blow up your account faster than you can say wrecked. Let me give you an example. Imagine the market is trending upward. Clean higher highs, higher lows. Price rips, leaves behind a bullish FVG. Now, instead of jumping in like a rookie, you check, where's the 50 EMA? If price is above the EMA and the EMA is sloping upward, guess what? That FVG is a golden retracement zone. You wait for price to pull back into that gap. You look for confirmation and you long. Not at the top, not chasing green. You buy from the place, smart money left unfinished. Flip it around. Market's bearish. Price dumps, creates a void, a bearish FVG. Later it retraces upward. But is price still below the EMA? Is the EMA curving downward, showing bearish flow? If yes, you wait for price to revisit the gap and you short. You're not panicking into red candles. You're calmly waiting for the market to return, test the imbalance, and reject. See the difference? Retail trades emotionally. Smart money trades logically. This strategy forces you to slow down, to filter, to wait. And that patience? That's where the money is. Now, let's get deeper. Why does this even work? Because price is not chaos. It's engineered. It's driven by liquidity. And liquidity means one thing. The market hunts orders. Fair value gaps are footprints of that hunt. They're the places where the market sprinted so fast, it left the crowd behind. And trust me, price almost always comes back to pick up those leftover passengers. The EMA just tells you whether it's worth riding that bus or not. Let's walk through some scenarios. Look here. The market shoots up, creating a bullish FVG. Price comes back down, kisses the gap, and then bounces, but notice it's still above the EMA. That's a sniper entry. Your stop goes below the gap. Your target? The next high, or even a measure extension. Clean. Now another one. Market dumps hard. A bearish FVG is left. Price retraces upward, tags both the EMA and the gap, then rejects. That's your short. And if you were watching without the EMA, you might have taken the wrong side. You might have thought, oh, it's reversing. But no, the EMA kept you in line with the trend. And here's another gem. Sometimes price will overshoot. It'll poke through the EMA, almost like it wants to convince you the move is over. That's manipulation. That's the market testing weak hands. But when the rejection comes from the FVG and price slams back below the EMA, that's your confirmation. Smart money just tricked retail, and you stayed patient. The beauty of this system is in its simplicity. One EMA, one concept. That's it. No rainbow indicators. Number 15 oscillators screaming different things. Just clean price action plus logic. And let me tell you the truth. Most traders fail not because they don't know strategies, but because they can't wait. They can't sit and let price come to them. They think more trades equals more money. Wrong. This strategy forces you to wait for that sniper shot. And when it comes, you take it with confidence. Now let's add in psychology. Why does price love these gaps? Because in those imbalances, there's liquidity sitting. Think about it. If price leaves behind an untested gap, it means traders didn't get filled. Orders are still pending. Market makers know this. They bring price back, fill those orders, and then continue the real move. You're simply following the breadcrumbs. And the EMA? That's your compass. If price is above it, you only look for longs. If price is below it, you only look for shorts. That single rule alone will save you from half your bad trades. Now imagine stacking this over and over. Every time price creates a fair value gap in the direction of the EMA, you mark it, you wait, you enter. You're not guessing anymore. You're following a structure plan. And structure in trading means consistency. Let's talk about results. If you master this, you won't catch every single move. And that's the point. You'll only catch the clean ones. The ones with confluence. The ones with math and structure backing them. And in trading, one clean trade is worth more than 10 random gambles. Think about it. A sniper doesn't shoot every target. They wait for the one that matters. And when they fire, it's precise. That's this strategy. EMA plus FVG is sniper trading. And let me say this, it won't make you rich overnight. Nothing will, but it will give you clarity. It will stop you from chasing pumps. It will stop you from being liquidity. It will train your eye to see structure in real time.